Hi, I'm David Traversi, and this is part of our series called How to Sell Your Business. We've been talking about valuations, and in this episode, we'll address public company valuations. How to Sell Your Business focuses on the sale of private businesses. So you say, why talk about public company valuations? Well, public companies that are similar to a private company in terms of their industry and operating business, we call those comparables, are relevant to the valuation determination, but not overly so. First, public companies are generally much larger and more valuable on an absolute dollar basis than their private comparables. Second, they are by definition far more liquid, meaning owners of public companies can buy and sell shares easily in the public markets, versus private companies where the ability of a shareholder to buy and sell shares is quite limited. Greater liquidity of shares generally makes those shares more valuable. Finally, companies that have gone public have been thoroughly investigated or due diligenced by investors and public market regulators, ostensibly lowering the risk of investing in that company. All other things being equal, the lower the risk of something, the higher its value. Given our assumption that the valuation of public companies usually exceeds the valuations of private companies, and usually greatly so, how do we use comparable public company valuations? Well, you use them as the high watermark of your valuation considerations. In our case study, Patsy's PPP has annual EBITDA of $1 million. She goes to Yahoo Finance or some other online financial information site, performs a search, and finds that there are 5 publicly traded pet services companies. She reads up on each of them and finds that 4 are much larger than her company, but generally offer the same types of services as her company. The business of the 5th is really quite different from hers, so she ignores that one. Then she sees that the 4 comparables are trading on average at 12 times EBITDA or cash flow. This means that on average, investors in those companies value the companies at 12 times the EBITDA generated by those companies. Given her company is private and much smaller than those public companies, her company is almost certainly worth less than $12 million or 12 times EBITDA. So 12 times EBITDA is the high watermark of her valuation consideration. Thank you, and look for future episodes of How to Sell Your Business.